Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boycenote with Kevin Casey, and today we are joined by Jason Bellevue. And we want to start by saying Happy New Year!
Woohoo! It feels like we've been away for like weeks.
I know. Well, considering we do this 51 weeks a year, going 2 weeks without it is sort of like, I don't know, stopping meth, maybe. It does become sort of an addiction because I'm constantly looking for content and things that might be interesting to talk about and all that kind of stuff. And I had to keep reminding myself there's nothing on Tuesday. There's nothing on Tuesday. It was weird. I don't know. How do you guys feel? Well, not you, Jason. I know that, every Tuesday is not for you, but how did it feel for you, Kevin? Or did you even notice?
I didn't notice. I just feels like it's
Okay.
been a month ago that we were on the show last.
I know. And it was not too long ago with Bill Dallas. So anyway,
Yeah.
so
And since referencing Donnie Tuesday just meant there was a show I didn't have to edit.
Well, so let's start with that, shall we? So Jason and I go way back. He is not too far from me in the Bay Area, and I'd known him for many, many years. And when we started this show in 2026, sorry, when did we start it? When did we start?
20,
2020.
2020.
God, what is wrong with me? Okay, so this is going well, obviously. Yay. 2020, March of 2020, it will be 6 years that we've been doing this. And at that point, it was, as we may recall, the middle of, not even the middle, the beginning of COVID. It was a total nightmare in the industry. Everything was changing. So I had Jason come on one week and talk to us about SBA loans. And he was my source weekly for my updates on what was going on with SBA,
Because there was a lot going
with
on back then.
PPP loans, and what was it, EIDL or Edelweiss loans or whatever they were. So anyway, he was the source. So that's how it started. And then he loved what we were doing and took it upon himself to start our YouTube channel for us a few years ago. So, or a couple of years ago or something. Anyway, that would have never, and I repeat, never have happened without Jason. So anyway,
Actually, you know what, Jason? I think that show we did way back in 2020 is the first time I actually met you.
huh,
Oh wow.
wow.
Because I have every one of them saved, Audrey, it goes back to 2022
What? Oh, YouTube.
when we started doing the YouTube channel.
Wow, was it that long ago? Holy moly.
Wow.
That's crazy. Crazy. So, Jason is about to dump a whole bunch of our shows onto YouTube, dating back away. So, anyway, if you have missed any of them, the rest of them will be there shortly. And Jason, thank you, because again, that would have never happened without you. And some people like listening to us on 1.5 or 2 speed. Okay, moving right along. Um, how about this? I'm not going to bug everyone about NMLS. Are you excited about that?
Yeah, we got time no more.
If you
Yeah,
haven't,
if you hadn't done it,
you are SOL. And but I'm really curious to get the numbers from DRE and DFPI like I did last year, because as we know, NMLS only updates their numbers once a year. It is typically
hmm
first quarter, the end of the first quarter. And so all the other projections and numbers you're hearing throughout the year are somebody pulling them out of their, I don't know, some orifice, who knows which one. And there we go. So we're going to talk about a few things this today. I just wanted to start with some good news. So one of the things that's been impacting inflation, et cetera, is rents. And we really are starting to see a marked decline. So we were at one point, rents were going up 14% a year. It was crazy. And so we are now down to Apartment List just came out with their December 2025. These are new rents. That's 47% of the market. And it showed new rents down 0.8 month over month and down 1.3% year over year. So assuming you're not a landlord, this is great news. If you are a landlord, renewals are a little better, so try and keep your good tenants. How about that? Also, we have a bunch of appreciation news. And next week on our show, we're going to have Nadia Evangelou, who is a senior economist for the National Association of Realtors. And I've actually asked her to comment on some of the things that I'm hearing in the industry, which is, oh, we need a big correction. We need a big crash. We need the values to go way down, which I just think is the dumbest, most horrific thing someone could say, because I can't imagine that the ripple effects of that wouldn't be just god awful. So I've actually asked her to think about this, and so we can talk about it next week to see what an actual economist thinks about it, not just us, right?
I
So
think she's going to say we need a strong dollar.
okay, she's probably not going to talk about the dollar because that's not her area of expertise. But does she think that to get us back on track with affordability, et cetera, do we really need housing prices to plunge? And again, I think that that would be a disaster. And we're not seeing anything pointing towards that happening on any index. So let's go through those really quick. Totality home price index for November, and they're often a little conservative. They were showing that in November it was down 1/10, but up 1% year over year. But going forward, their projections for the next 12 months is that we're going to be up 4.3%. So obviously this is these are national numbers. So check your area, see what's going on there. But the good news is that, I mean, that's positive, right? Case-Shiller FHFA came out with their October home price appreciation numbers. The seasonally adjusted Case-Shiller numbers were up 4/10 and month over month and 1.4% year over
This
year.
is for last year or projected?
October of 2025.
So last year's number.
It was, these are the most recent numbers. This is how it
I
goes.
got it, got it, got it.
Yeah, we just, Kevin,
I'm just trying to write this stuff down and I get an understanding of it. And what number did it come in at?
my God, what?
What what number did they come in at?
Seasonally adjusted up 1.4% year over year. FHFA, which does not include, to remind you, cash or jumbo, was up 4/10 month over month, seasonally adjusted, and up 1.7% year over year. And then pending home sales for November were up 3.3%, and they only expected them to be up 1%. And then October was revised from 1.9% to 2.4%. So that means that home sales were better. Kevin, did you get that?
A
Pending
smidge.
home sales better. So
Right.
the West was the strongest, which was promising because we have not been in the lead as far as pending home sales and appreciation recently. And so that was nice. And these are the highest pending home sales numbers in 3 years. So
Nice. Oh, well, didn't NAR come out last year and say it's 4% projection for 2026?
they are expect not for pending home sales, but for sales. Yes.
Sales, yes.
So
For
yeah,
values increasing.
pardon me.
For increased value.
Yes. No, a number of transactions done. That's what they're and wait, okay, now I'm confused. Anyway, we're gonna have NAR on next week for God's sake. So we're gonna
Oh, we'll
talk.
ask them. There we go.
Oh my
Why
God.
why wait around for a week though?
Okay, so hang on. So it's been at least 3 weeks since I thought about those numbers. Okay. Redfin again, they were also positive. My point is all this talk about waiting, everything will be better. It's just no. You're going to lose money if you're not buying and getting your transactions done sooner rather than later. That's the point, regardless of all the intricate little statistics that I do love. So, Kevin, are you clear? Are we clear?
Somewhat. So buy today, not tomorrow,
Okay,
because it'll be 4% more next year.
gotcha. Yes. Values are going up nationally is the what we're seeing. Jason, what are you seeing in your area?
Anecdotally, I can tell you that as you know, I do real estate as well, and I have a listing that was only on the market 7 or 8 days. Went, pending very quickly, no contingencies, at right about at asking.
Wow.
So, and asking was pretty significant for this property. It was over $1.8 million.
And how
Uh,
close to market was the asking price?
I'd say we were a little on the high side. And
Really?
actually,
Huh?
yeah, we were a little on the high side. We took a non-contingent offer a little below where we were at asking. more closer to, as we all know, we have clients and sometimes they think it's worth more than it really is. Um, but the offer came in just a little below asking, with no contingencies, and they were like, they accepted the offer. So I felt
Nice.
very comfortable where we ended up at. And again, I think it was only up for 7 days.
Wow, that is really great news. And it's also, I think what we're seeing too is the other thing too is the realtors have to be good. You cannot have some schlock, dialing it in realtor on these transactions because things do come up. And one of the things that we've been seeing is that deals are taking longer for myriad of reasons. So it, yeah, what are you seeing?
I'm going to say I agree 100%. And you and I kind of discussed that a little bit earlier. Um, it is definitely taking longer. They are more complicated. It's just the nature of where we're at.
Yeah.
We're getting plenty of business,
Yes.
but again, far more
Lots of
complicated.
hair. Lots of
Yeah,
hair.
far more complicated and taking longer than it should. But they're not dying, and that's a positive.
That's right. I okay, listen to this. So I have a deal where there were already two appraisals for various reasons. One at 1.4, one at 2.2 for the same property. I ordered an appraisal and it came in at 550. I mean, I've never seen a swing like this in my entire career of 388 million years. And it was so unbelievable.
Wait. So let me guess. Let me guess this, since you had to have three appraisals on the same place, that they
No,
were negotiating on a transaction and
no.
different parties ordered each of their
Oh,
own.
yes.
Yes.
Sorry.
And and someone had some influence over some of those appraisers.
No, no, I don't believe that is the case. I think that the appraisers, it's interesting because when you looked at the appraisals, if you didn't know the area, you would not have a clue. So that when I looked at my 550 appraisal, if I
Mhm.
hadn't known what I knew, which is it's on a lake, does it have a dock? How much is that valued? What is the access? What is the view? All that, right? All of that matters. If I had just looked at this appraisal, I would have been like, like,
Yeah.
right? The comp seems solid. When you took all of that and added in the actual facts around that lake and someone who knew what they were doing, I mean, it was so off. So I was able to order the AMC was like, oh my God, this is terrible. And so we have another appraisal that's happening. But I mean, that takes
So
time.
you're going to tell us next week what that appraisal came in at?
Well, at some point I will, yes. So, but my point is, again, I had to do a lot of homework on that, right? I had to understand that market. That is not a market that I'm in. It is a vacation destination, etc. I had to go to bat with the appraisal department, then the AMC, and well, they did it for me because they realized how bad it was. Anyway, the point is, if you don't have a professional in the mix on your deals, you're toast. I mean, you're just toast. And whether it's income or it's employment or it is credit or you have to have one of us helping navigate this. There is no way on the face of the earth that a computer could manage this.
Yep.
And also you can't have some green person who has no idea who's doing loans in a vacuum somewhere, just taking the low hanging fruit. They're not going to know how to deal with this. So again, I think 2026 is the year of educated professionals in our business who are doing what it takes to be in touch with the economy, in touch with the latest underwriting guidelines, in touch with what's available, because we have so many loans that we can do. I mean, so many different things at our disposal as far as options for our borrowers.
There's
So,
so many ways we can do them too, which is
mm,
nice. But
yeah,
sometimes it gets very confusing when you go, well, we could do it this way, we can go that way, we could do it this way.
yes. I mean, and Kevin and I, when we've been talking lately, he's getting, how many referrals are you getting? Tons, right?
Yeah, lots of them. I've got like 10 open loans right now, but Like they all have hair on them. Oh my God.
All of them. Yeah, 100%. Do you go bank statement or P&L? Do you go borrower
And
or lender?
stuff in my 30 years I've never dealt with.
Yeah, it is crazy right now. So anyway, the point is, I think we're well positioned going into this year because again, the people who listen to the show, the people who have their nose to the ground, not just 8 hours a year in their NMLS class, but weekly are going to be able to help their borrowers better than anybody else. And you can differentiate yourself in the industry, in your area, with realtors, with your referral partners, with your clients, and make sure that you are, the first thing person they think of when they have an issue. And also be out there getting the word out that it's not this little vanilla box anymore. We have this whole world of other options, right, Jason?
Absolutely.
So,
Absolutely.
Jason, you have a little side hustle, I believe. It's the current California state president of camp.
Yes,
That
incredibly
is,
well-paying job, I understand.
well, I believe you've had it. Has the pay gone up since you had it?
Well, let's see. It was COVID when I was state president and we were in lockdown. So I was doing, I don't know, 40 hours a week on that and like 50 on mortgages. And so God knows how much that job cost me during that time period, right?
Uh-huh.
Good for Kevin. So
Yeah.
anyway, yeah, so let's talk about the associations and not just camp, but the national associations and wherever people are in the country and their local associations and how important they are as far as what is happening in the industry and what we need to be thinking about right now.
No, absolutely. And as many of you know, for example, we know that trigger leads legislation passed at the federal level. But as I hope you also know, we're not even sure who's going to enforce that at this point. There was discussions of the FCC or the CFPB, but nobody's sure what's going to happen now. So we know it's coming down to the state levels, and that's where organizations like CAMP and FAMP and some of the organizations all around the country, because most states have them. Those organizations are the ones that are going to have to be out there communicating with the state agencies and with the states on how this is going to happen. That's one of the things we're doing here in California is we have contacted the legislature and we're helping them to determine, what the type of penalties should be, what the type of legislation should be, or implication should be for breaking these regulations, instead of leaving it up to who knows who at the federal level. And, as I've been saying in camp, we know with the CFPB and the shape it's in that it's going to get pushed down to the state level, and we want to be out in front of that. We want to make sure that whatever is happening, we've got a say in it.
Yeah.
The issue is that we have this legislation at the federal level, which the states can't, they don't enforce federal law. So that's why it's so important that the states are created. And we do have a number of states right now who have their own trigger lead laws. And the states were a little surprising because you wouldn't know that they would be out in front, like Idaho. I mean, who would have thought they would be one of the first ones? So
Texas.
Texas, I know.
Texas is one of the early ones. I was
Yeah.
stunned.
So
Yeah.
anyway, so to say that this is important at a state level, I believe it should be front and center for every state and something that happens very quickly because we all know it takes a while to get through the process be enacted and then to be enacted. Like so they pass the law, but then when does it go into effect, et cetera, as we saw with the federal trigger leads law, which is, it there was a 6 month lag. So it doesn't even go into effect until the beginning of March, which everyone's trying to figure out how to get around that even. Just always a reminder, there is a look back on these things. So if something changes in the administration or the focus for us at a federal level, then they can go back at the CFPB, they could go back 5 years and nail you for some violation, even when it wasn't being enforced. So just because it's not happening at the moment doesn't mean it couldn't bite you later. So anyway, Jason, I mean, we need people to be involved in this process and to support it and to get the word out to the consumers and So I mean, we always promote the calls to actions from both the state and national associations when we catch wind of them. So yeah, we want.
Yeah, I was reading an article over the weekend about how forget what this government entity, but they're required by law to reach out to trade associations. And since loan officers tend to be very independent and off on their own locations and working isolated, it's really important that you work with your trade association, be involved, see what's going on, because you actually have a say. And you complaining to your wife or your husband or your coworker doesn't do you any good unless you go and complain to the legislator, and they're required to listen to it. And we've learned, Audrey, Jason and I, we've learned that you go to Sacramento, or you go to DC, they listen to you, and then, if it wasn't for us, we were there getting those bills passed. We were very active in getting the trigger lead bill passed. And it was really eye-opening how the process works, and it does work. Doesn't work fast, but it does work.
But it also
No,
is good to remember that I remember when I first started going to Washington, D.C., and I've talked about this before, and it was right after the meltdown, and I walked into legislators' offices, and they just looked at us like, you're a broker, you are the enemy, you caused this mess. And it took years. I mean, we'd talk about trigger leads then, and
Mm-hmm.
they literally said to us that the only reason we didn't want trigger leads was we didn't want the competition. They had no idea what an egregious practice it was. They had no clue. It took literally years of NAM, it was the National Association of Mortgage Brokers, going back year after year after year after year after year, having these conversations. And finally, we got some of the other associations got on board at a national level, and it all came to pass. And now it's like, shit, we should have just done the states. Anyway, but who knew?
So I don't know if you saw in the chat, Audrey, but we have Linda Connor chatted in. Arkansas, Connecticut, Georgia, Idaho, Iowa, Kansas, Kentucky, Maine, Rhode Island, Texas, Utah, Wisconsin, all have their own trigger lead laws, and all of which are stronger than the federal law.
Oh,
So
wow.
and
yeah.
and there is a senator who took up the one here in California, so California will have a stronger one as well, provided it goes through. I don't foresee it not going through, as last year when we were working on it, we left packets, and I have had 3 different offices call after the first one going, "Hey, we want to bring this forward." And I said, "Well, please join forces with this particular senator." So I would say California is going to have a stronger one as well.
Great. Hopefully by
In
March.
what ways will it be stronger?
Just some of the regulations and limitations as to what people can get away with. It's really what it comes down to.
And is it limited just to mortgages or other industries?
Good question.
Because I heard a great
So-
case, other industries where someone was searching for engagement rings, and then they figured out who he was engaged to through his social media, and then they started targeting his fiance for wedding plans, and she put 2 and 2 together, like, oh, Jesus.
Are you
Well,
serious?
and what I can tell you, is that with regard to what we wrote, it is somewhat focused on mortgages, but it is kind of generic in that we also discussed when we were meeting with people examples of people looking for insurance who ended up having seen trigger leads
Yep.
type of interactions. So
Yep.
it's a little more generic in that, yes, it covers mortgages, but that we talked about it covering other areas as well.
Interesting. Okay, so in other news, this was interesting to me. Personal bankruptcy filings are up 11% year over year. Those are personals. And then businesses, those bankruptcy filings are at the highest level in 15 years. So do the math backwards to 15 years ago and figure out where we were then. So it is a time that we need to focus on getting in touch with our clients and making sure that we are helping them before they are in big trouble, encouraging them if they think they're going to have a cash flow issue, if they think they're going to have any, make sure you're getting in front of it. Because as we all know, you can't be asking for credit if you're in
When
trouble.
you don't, you
Yeah,
can't afford it.
exactly.
Yeah.
Exactly. So I thought that was something. So Peaches made a comment here. If you'd noticed Jason's face go sheet white, she said that Jason is doing such an excellent job that he'll be camp president for the second year in 2026 and 27. That's always like the scariest thing for a current camp president to hear is, we want you to do it again. So anyway, I thought that was funny, but also true. You're doing a great job. You and Dale DeJaneiro, who was president last year, you guys have done an exceptional job of bringing this association back to a place where people are excited to go to parties, go to events. They're really seeing the value of in person. That is so critical. And so you and your team are just doing great, Jason. You should be so proud of yourselves.
No, I agree. And yes, Peaches threw in her 2 cents, but she's also the vice president. So she
Okay,
has a
well,
little.
okay, we just got another comment from Lynn that said, I second that motion. So it's not just your executive board, okay?
We can take a vote right now on the
Yeah,
show.
exactly.
Let's not.
Right now. We don't care if you're a camp member.
Hey, so Jason, what else you got working on the statewide for California?
So here in the state in California, one of the things that we have that not every state has is we have a broker activity report that we have to produce as brokers. That is a DRE activity report. And the irony is it's the same report we do for the NMLS. It's a call report. It's just an exaggerated call report. So we end up doing the same stuff over and over again. And I was looking to try to get somebody to help with legislation on this to do something about it. And I will tell you, the DRE stepped up and they came to us and they said, listen, we talked to our enforcement people. Here's the things that they're concerned about. And I said, that's great. That all has to do with private money lending. It has nothing to do with your average broker who's just brokering loans. And they went,
Right.
really? Yeah. And they went, really? And I went, yeah. And they went, so instead of moving forward with legislation, which I had some senators I was talking to who were interested in it, they want to do a panel because they legislatively can make changes in it. So,
Nice.
that's one of the things we're looking at. One of our suggestions was, how about just a checkbox at the top that says none of this applies to us, and off we go.
Yep. Yeah.
Wow.
So, I mean, and this is again something that we've been going to the DRE with or about for years. And so finally they're coming around and they're seeing things in a different light. And they really, I know this because I've been in front of their commissioners for dating back to Wayne Bell, and who was what, 3 commissioners ago. And they know that the people who are involved in the associations are typically or mostly the people who actually are trying to do things the right way. They are trying to be more ethical and take care of their borrowers first, etc. So it's nice when they're reaching out to you as the association to make sure that our needs are being attended to. I also had seen a recent update from the DRE that is urging real estate agents to be on alert for vacant land scams. And I know this is going around in other parts of the country as well. They're targeting, these bad guys are targeting either investment properties or vacant land or some sort of situation where maybe the borrower is or the owner isn't living there and won't receive the mail, and then they sell it.
It won't notice a for sale sign going up on their lot.
You don't even have to have a for sale sign. All you have to do is just, somehow you can some schmo to sell it. I mean, I have a situation right now that I cannot even believe that either the buyer or seller agreed to the terms of this thing. So, so people are getting sucked into these scams all over the place, and we need to help them understand to not click on things. Don't believe what you're seeing on Instagram, TikTok, or Facebook. I mean, it is egregious, some of the things that are happening. But again, we've heard about this vacant land thing and the investment properties, et cetera, being
And it hurts both buyer and the owner,
big
because
time.
the buyer buys the lot and then, thinks, okay, I bought a lot. I never met the seller, but they signed off on everything and I've owned the lot and now I'm going to build this house. And then the owner comes by and says, whoa, wait a minute, why is there a house being built to my lot? And, stops the process. And now the guy who thought he bought a lot and has a house built up on it suddenly doesn't own it. And, that's a big problem.
It is.
Well, and it becomes a title fight, which
Yeah.
can take forever. Title insurance is involved. I had something similar happen to a client of mine who bought a property, but there'd been a hard money loan on it somewhere along the line, and it
Uh-huh.
didn't get cleared properly. And then the hard money people, because it was an investment property, the hard money people foreclosed on it and sold it out from under him. And he went, "Wait a minute, what?" Because he had bought it, the hard money should have been paid off. He spent years fighting this thing. Eventually it got cleared, but both the new buyer and he ended up with lawyers trying to deal with this and the title company in the middle.
Wow.
I have a situation right now where it was referred to me by attorneys. There's two attorneys, one on each side. I don't know why on earth the sellers thought doing this deal was a good idea. I don't know why the buyers thought it was a good idea, but it is a disaster. And I am going to have a conversation this afternoon with the attorneys and a title officer about how we deal with this mess. It's a mess. And so, again,
That,
people,
that one, lots of hair on these loans lately, huh?
oh my gosh, unfreaking believable. Yes.
Yeah. And Audrey knows I'm dealing one with an abatement
Uh,
from the city on a, in open permit that was never completed. And then they're trying to sell the place, and it's like, well, you got to clear the abatement. And he's like, well, they can subordinate the abatement. I'm like, yeah, no lender's going to want an abatement. Like, no.
Not that particular abatement, apparently.
Yep.
Hey, Jason, just FYI, I'm getting text messages with more people voting for your second year as camp president. So they keep coming in, kids. I think by the end of the hour, we're going to be we'll know what our new camp president for next year is going to be. Okay, so I thought,
I don't know who started that, and she and I are going to have a talk.
she moved out of state. She doesn't care. Anyway, okay, so
Well, Jill here is talking about condo associations being underinsured and stuff. Believe it or not, that's one of the other things we're working on here at camp is we're dealing with not the underinsured part of it, but some of the costs and fees associated with getting the documentation in the time frames. Here in California, they legally have 10 days and they can't charge a rush fee in that 10 days. And I've argued that that's not reasonable on any side of things. Transactions are moving too fast for that, especially from our perspective as mortgage people. By the time we're even into the transaction, we're normally 5 to 7 days into it, at best before we're even ordering the lender questionnaire. As an example, and those questionnaires, when you start adding all these fees, I had one client who paid like $700 for it because she wanted it in a day. So we had been talking with legislators on it. It was one of the pieces of legislation. I have a senator's office who is very interested in it because the specific aide, had just sold a property and was charged like $500 for her documents as the seller. And where it stands right now is the association and lobbying group for the HOAs and the HOA management companies has come to us and said, okay, instead of pushing the legislation right now, can we work through this and talk about it? So by doing this, they connected the DRE. The senator's office contacted the DRE. The DRE came to us and said, hey, we have connections over here. Maybe we can work this out without doing legislation. And for those of you who don't understand, legislation forces stuff. So 9 times out of 10, if they have an option, they would rather not it be legislated, that it be a
Absolutely.
choice they make.
Yeah.
So that's one of the reasons we're getting, for example, the DRE coming to us on the broker activity report And we're having the HOA organizations actually talk to us because they know that we have proposed legislation that would then affect them. And obviously, especially with HOAs, there's new laws here in California where HOAs are limited to the penalties they can charge. So they're already being, there's already legislators going after this. So I think it's a great idea.
I just think that a lot of this needs to be legislated because until they're threatened, until you've got your foot on the fire, they're not doing what they need to do. So only the threat of legislation is galvanizing them to take care of their homeowners. I mean, yeah, no. Anyway, I thought
Well, actually, I gotta say that it's really interesting. There's a lot of organizations, and you said this yesterday, ours included, that are just concerned about their bottom line, not about doing what's best for the consumer.
okay, so what he's referencing is a conversation that I had over the weekend with somebody, and I get frustrated with our industry because I'm doing research all the time for this show. And I listen to a lot of different people, a lot of different podcasts, a lot, and I can go for a long time where you've got these higher level, get a salary every week, C-suite people, what owners, whatever. You can have a whole conversation about the mortgage industry, and never once does the homeowner or the buyer or the borrower ever come up in conversation. And that, in my opinion, is egregious. So we are focused on the borrower. We're focused on how this affects the homeowner. And I believe that that is what we should be focused on and what is important in this process. But it's been lost because this industry has been monetized to the point where all that matters is quarterly earnings and growth and growth. And it's all predicated on when is the next refi boom. And all that does is you have a short amount of time where a few people come in and make money. And then the rest of us are left for the next in this case, last 4 years that's been crazy difficult, and it's not okay. So again, focus on the borrower. That's what 2026 should be about, is focusing
Yeah.
on the borrower.
Unfortunately, though, the legislators get convinced that having more LOs come in when the rates go down to shorten the time frame of how fast a loan can be done is in the best interest of the borrower.
I I've never heard a legislator say that. I do. I mean, they want them to have options. I think, is that
Yep.
what you're talking about? Having,
Yep.
yeah. And again,
Well,
a bunch of people who are coming in because they can make a lot of money. I just want to slap the living crap out of someone who says that, because it's so awful for the borrower. Jason, what were you?
well, well, this supports your point. The trade organization for the HOA management companies and that stuff, when we're having these discussions, have kept saying, well, but you want to regulate what a private business can make. And I keep looking at them going, do you know what I do for a living? Do you have any idea how much regulations are on us?
Well, and again, we're thinking about,
If we can be regulated and we can be regulated on what we make, then why can't you be? Because you're directly affecting the client just like we are. That's why we're regulated.
exactly. And again, they're not concerned about their owners. They're concerned about their bottom line, which again, I'm not saying that we shouldn't be aware of our bottom line. Everyone needs to make money and make a profit. I get it. I'm on board with that idea, 100%. But how much? I mean, again, when you look at the amount of money some of these companies are posting as their quarterly earnings, if they're, I mean, and look at Fannie and Freddie, quarter after quarter after quarter, while the entire industry was sucking wind, Fannie and Freddie are posting huge gains. And that, in my opinion, is of note because they're making a ton of money, way more than is necessary to charge each individual borrower. And then they whine about affordability, and somehow it's LOs who are the issue. I mean, it's so upside down. Okay, I'm going to move along on this because, uh, okay, another, uh, thing that I thought was interesting, because we know that credit report fees have gone up, 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 up. Okay, that's too many ups, but a lot of ups for the last 4 years. And MBA sent a letter to FHFA, so that's Fannie and Freddie, saying that they would like to see a system where high FICO scores, that means people over 700 was their number, only need to have one bureau pulled. And so I have 1 million questions around this approximately. Let me just throw a couple at you. First of all, how do you decide who has good credit, who doesn't? If you are looking at
Oh, I know. Wait, I know. As soon as I meet a client, I know what their credit score is.
if you are making that determination, I promise you're going to be accused of discrimination at some
Oh, I totally discriminate on that. You know, the highest credit scores to get the better deal. Lower credit scores, lower deal. It's that
Okay.
simple, Audrey.
Are you going to decide, right? So we're supposed to treat everyone the exact same,
Uh-huh. No,
right?
no. You can discriminate based on credit scores. It's legal.
What?
You can legally discriminate based on credit score.
That is not the point. How do you,
Yeah.
before you run someone's credit, whether they're good or bad? That's the point. So
Um,
if
I used
And
to do
Kevin,
this. I've said this before. I used to have my processor pull credit reports when I would meet with clients in the office, and I'd always have a bet, like I could be within 5 points of that credit score before he would pull it. And I was almost always within 5 points of the credit score.
I promise you that that has been some of the time, that is definitely not all the time.
Mhm.
And
Yeah, there's always the outliers. Yeah,
so many people you cannot tell.
yeah.
So many.
I had a client right now. They had perfect credit scores before, and they went to another lender, and then they came to me and they're bragging about their 780 credit score, and I pulled it and I got a 680 because oh, when they pulled their credit score, that triggered something with a collection agency, and the collections agency threw a collection onto their credit score like the day after the other lender pulled their credit score. And now suddenly they have like a collection that's due from like 6 years ago, so it hasn't fallen off. But the collection's like, hey, we can grab this money now because they're applying for a mortgage. They're going to have to pay us in order to do this, whether or not they really owe us or not. Well,
Situation where I told a borrower that there was a collection account on their credit report. They had no idea because their
yeah.
identity had been stolen by a family member. So that
Oh,
person
yeah, that's a crazy story.
ran and ran up all these debts for a number of their children. So this person calls said creditor, disputes, says they open it. The creditor, who I'm not at the moment, said put it in dispute status within 30 days. And then the next thing, they received a lawsuit that had been filed on behalf of that creditor, suing them for the amount of the collection account. It's so bad. It's amazing. Yeah. And by the way, Peaches said it's not discriminating. It's called risk factor when pricing is based on credit scores. And that's not what we're talking about. We're not talking about risk-based pricing. We're talking about how do you decide whether you run one bureau or three bureaus based on a conversation with someone. That's what I would like to know.
I
So,
So you
agree.
run
It,
one.
but
If you get a 660, then you have to run two more. That's simple.
okay.
But an interesting comment you made, Kevin. You have rental property in the state of California. Can you discriminate regard to Section 8 in their credit scores if somebody applies for your property
No,
to
you
rent?
can't. No. No, you can't do that. Well, no, there are some
No,
landlords that will not rent because a
you
lot of
cannot
lenders
cannot do that legally anymore in the state of California.
really.
If somebody with Section 8 applies, you cannot deny them for being Section 8. And you can't judge them on their credit score. And
Okay.
the only income you can
Well,
judge them on is to make sure they have enough to cover their portion.
yeah, that's fair enough. That's Section 8 because the state's making the payments. So what are you worried about? Um, if it's, but I see a lot of landlords that, you know, they'll require that the renter provide a credit report.
Oh yeah, and they do, but you can't deny them on it.
Yeah.
So just as you were saying, there is instances where you cannot discriminate based on a credit score.
Yeah.
All
Yeah.
right, let's talk the Fed for a minute, shall we? So we were promised
Sure.
that we were going to that Santa was going to bring us a new Fed chair by Christmas. That did not happen. Now we're being told January, so who the hell knows? So we also currently have the shuffle that is going to be happening where some of the members, not all the members, right? So they're going to, some of them voted last year, who participated in the December meeting where up with the dot. And that showed that on average, they were expecting one cut this next year. So anyway, I thought it was interesting because we've got outgoing Fed member Stephen Marin, who will not be on the board after January 31st. He wants 100 basis points in reduction. Then you've got all the rest of them who are all over the board saying, we're fine. Or there were even a couple of people who wanted to raise rates, which is interesting. And yeah, so anyway, so we've got this shuffle that's happening, and the current odds are that we're going to have 50 basis points in cuts this next year, but as we know, that could change at the drop of a hat. The Fed has also clarified that they are planning to buy short-term treasuries in the amount of 220 billion in 2026. That's a big number in my world. I don't know, maybe not in the greater scheme of things. But what the thought is on that is if the Treasury is buying the short-term debt, then maybe the mortgage-backed securities, the longer-term debt will be more attractive, and we'll have more buyers for that. So that'll be interesting to watch. Yes.
Will
No,
be.
for sure.
Yes. Yes.
Well, and ultimately, if the Fed's buying the debt, shouldn't that help interest rates go down, which should actually increase the market theoretically?
Well, again, they're going to be buying short-term treasuries, not mortgage-backed securities. But yes, in theory, it will soak up some of that treasury
Right.
that's being auctioned.
Well, and based on the fact that I kind of specialize in commercial and SBA and some of those things as well, yay, because that's going to drive commercial rates down.
Let's talk about SBA for a minute because a lot of people are afraid of it, and there have been changes in recent months. And the SBA deals that I've done you can do them. Like they're not difficult.
They're
They
not that complicated.
a whole different thing, but it's just like you learn any other product. If you put your mind to it, you can figure it out. If you have the right resources, you can do it. So talk to us, Jason, about where SBA is right now as far as are they lending? How are they lending? How is that market? And what does that look like going forward?
So what I can tell you right now is there's some changes coming in March, some pretty big changes. And it has to do with the fact that businesses are going to have to be 100% owned by either U.S. citizen. You have to be a U.S. citizen, U.S. national, or lawful permanent resident alien. It's that simple.
Not surprised.
Right. And for the most part, that's the biggest change. They've got a couple other things. Previously, the SBA required like 51% ownership was a U.S. citizen. Now it's 100%. It's that simple. 100% has to be owned by, somebody that meets that criteria, U.S. citizen, U.S. nationals, or a lawful resident alien. So that's the biggest change. The other one that's out there that they're talking about is so there's 7A and 504. 7A, think of it like a HELOC. That's the easiest way to explain it, but it's based on the Treasury. There's some advantages to a 7A. They've got a shorter prepay period, that type of stuff. Those go to 5 million. The administration has talked about increasing those to 10. 504s are a first and a second. The second is actually done by the quasi nonprofit that's SBA based. They're called the CDC. And they're talking about moving those, which are currently at 10 million, to possibly 20 million. Key to a 504 is there has to be real estate involved. So they're talking about increasing the size. Currently, there's a small balance SBA as well that goes to 350, and that would increase as well. They're called the 350 is called a micro, and it's pretty easy to do. The application, you have to still work through one of those SBA lenders, and the application is generally done online. It's an SBA app online, and it's supposed to be quicker. For the record, I agree with you guys that there are some SBA loans that are very easy to do. It takes a little work, it takes some time, but you can do it.
Mhm.
They're not all that way.
No, 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 of course. It's a
They're
more,
not all that way. I am in the middle of one that is nowhere near that way. Um, and especially when you've got a client who maybe needs to have things like projections because it's a startup, or SBA. Most people don't realize SBA will do ground up construction. They'll do construction in general. I did one where we purchased a building and did over $250,000 in build out for it to meet the needs of the client coming in. So SBA can do a lot of things people don't realize it'll do. But the more complicated it is, the more you've got to be connected with the right lenders because they don't all do it. So there is aspects to it. And then being able to write projections and write business plans or understanding what the projection should look like. So I don't disagree with you. Some of them are very simple and any loan officers can do it. Some of them are much more complicated and there's ways to help with that. I have sources that help with that as well. But SBA really is a wonderful tool if you understand how to use it, and it can help your clients immensely. Those are the big changes. The you're going to have some equity injection requirements for new owners, that type of stuff. But for the most part, you're 10 to 15% down on most businesses.
so
Um,
clear, I wasn't saying they were easy. I was saying they are, that you can learn them and you
you
can
can.
any other program. And again, we need to be open to working, learning new things, and making sure that we are not just throwing someone away when we could actually close their deal. So
No, absolutely.
doing them forever, and certainly I would consider you to be one of the experts in the space as far as knowing how to write all those projections, et cetera, what they're looking for, et cetera. Don't roll your eyes at me. And so if somebody needed help or just wanted to refer their deal to Jason, you could do that. But again, take a dive in and see, because we learned this business by doing it, all of us. I don't know anyone who just, took a class and then poof, they were ready. They just, everything that was valuable, I learned by just doing it. And half the time, I didn't know what the hell I was doing when I started, and I just figured it out, including things like rehab loans, et cetera. So,
Yeah,
do
just
you,
do it.
right?
And don't shy away. Although sometimes it doesn't hurt to have someone who specializes in it and refer to them and if they're in the same company, and get a referral fee sometimes. But
We need mentors. We need mentors. We can't get referral fees, Kevin. We are
if they're in the same company, you can't.
okay.
That's what I said.
Be careful when you say things like that. People will misconstrue it, and that's why we end up with.
Uh,
Yes, I agree with you 100%, but it's also an SBA, so there's some different aspects to it.
yeah. Hey, I want to pivot here a little bit. I know Audrey already forgot, but I found something in the last week that was quite interesting relating to costs of home purchases and such. I found a 1969 closing statement for a home purchase in San Francisco in the Sunset. Now, today, a home in the Sunset, two bedroom, two bath, probably $1.4 million. What do you guys think the purchase price was 50 something years ago?
Just tell us.
$31,000.
Closing costs, Kevin.
Yeah, yeah. But the really crazy part was how many line items were on the closing statement. Just give me a guess.
Just read them.
Read them.
I want you to read what they were.
Read them. All right. Okay, purchase price, $31,000. Down payment or initial deposit, $3,100. So they put down 10% initially. That was a pretty hefty initial deposit. Their down payment was another 10%. The loan, $28,000. Insurance for the year, $147. Actually, insurance has not gone up that much when you think about it. If you paid $147 50 years ago, it's only gone up maybe 10%. So insurance, as much as people complain, has not gone up that much in relative to these other numbers.
Keep going.
All right. Escrow fee, $200. That hasn't gone up much either. They're not that much higher. A reconveyance, $84. Notary fee. How much you think the notary fee was, Jason? 50 years ago.
Based on the fact that it's like $20 now, I'm assuming it was like $5.
$2.
Two.
$2.
There you
Yeah.
go.
Yeah, and I think that's because there's two people signing. It was one per. That's my guess. And I bet that was restricted by the state at the time. It was $5.60 recording fee. Recording fees aren't that much these days either. I mean,
Yes, they are. Keep going.
all right. The lender fee, obviously was an in-house deal, was only $186. A tax service of $15. Tax service isn't that much either now. It's maybe like $20 or 30, maybe $90 or something like that. And termite inspection, $25. So the notary made $2, but the test termite inspector, he made $25. No. All being
Well,
said, that's all the line items, a grand total of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 line items on that purchase transaction.
what was the total of those line items?
So they bought the house for $31,000. The total was $538.
That's something else. Wow.
Hey, Audrey, there was a question in the chat. Do you mind if I answer that real quick on the SBA stuff?
Yeah.
Absolutely.
So with regard to SBA insurance policy or lien against the home. So they can only lien against the home if there's equity in it to do it. So if they can, they will. I will tell you, they will also allow you to move it around because I have a client who had an SBA loan against one of his rental properties, and every time we refinanced it, we just moved it to a different rental property. So we just kept moving it around. So, but again, you have to have equity to do that or have a property to do that. And with regard to insurance, if there is no real estate involved, then they want you to get a life insurance policy. And you can do it without real estate involved. We did one on a horse barn, and it was build out stuff. So it wasn't actually on the property because she was the renter of the property. We built out 2 other barns, a bathroom, all kinds of stuff. But because she wasn't the owner, they couldn't lien against her property. As a matter of fact, she rented on the property. That's where she lived. So
Great. All right. And I just want to tie Kevin's little scenario up with a ribbon because when they're saying that things are unaffordable, I mean, they had to put down 10% as a deposit. That's crazy. So, I mean, and if you think about what things were every back then, $3,100 was not a little amount. So
That was a lot. That was the average income back then was maybe
don't guess.
$2,000, something in that range.
So, I mean, I just think that when we're talking about affordability, we always have to remember what our lifestyles are now versus back even 10 years ago and what the expectation was for, how many Louis Vuitton purses you wanted to have.
I mean, a cup of coffee back then was 10 cents.
Just to wrap it up, this is the year where we as loan officers drive our own business. We drive how much business we're going to do. I've been talking about MBA mortgage applications for a while now because I think it's interesting when we see the purchases are up 16% year over year, refi is up 110% year over year, but we're still waiting for rates. Don't wait for rates. It's not going to get much better, if at all. We are right around 6%, a little below, a little above. And that is going to, I think, continue. And so this idea that we're going to have some huge refi boom, I mean, again, I don't even want that. I want us to have a stable market where we are working to help borrowers and we stay focused on that. That I think is our way forward, is be a really professional loan officer and focus on your client's needs, and you're going to be fine. So on that note, Jason, thank you so much for being here today. I know this is outside of your comfort zone and you did great. And we are really impressed with all that you've done over the last couple of years with the associations. And we, again, encourage people to join at the state and national level to make sure that our voices are being heard where it's important. And so everyone, it's a new year. It's a new week. Get out there, go meet people in person, go to industry events, And we'll look forward to talking to our economist next week. Have a great week, everyone.